receipts, and they're at the end of year. So Bernie Company, who's the leaser, enters into a lease with Fox Company to lease equipment to Fox beginning January 1st, 2019. The lease terms, provisions, and related events are as follows. The lease term is 4 years. The lease is non-cancelable, requires annual rental payments of $50,000 made at the end of each year. The equipment costs $130,000. The equipment has an estimated life of 4 years and an estimated residual value at the end of the lease term of 0. Fox agrees to pay all executory costs directly to a third party. The interest rate implicit in the lease is 12%. The initial direct costs are insignificant and assumed to be 0. The collectibility of the rental is reasonably assured. Assuming that the lease is a sales-type lease from Bernie's point of view, calculate the selling price and assume that it's also the fair value. So we can do that first, and we'll use the present value function. So we'll say equals present value, open parentheses, rate of 12%, comma, number of periods, 4, comma, payment, 50,000, and because this is the beginning of the end of the year, we don't have to worry about type, so we can just close parentheses here, and we get 151,867.47. And I'm going to put the negative sign there so it's positive. And just a reminder that this is giving us a more exact number. If you were to use the present value tables, you might have cents that are off a little bit, and so sometimes that causes issues within Cengage or whatever platform. But anyways, going on. Part 2, prepare a table summarizing the lease receipts and interest income earned by Bernie. So as of January 1st, 2019, we have the lease receivable equal to this 151. So we'll pull that down. Then the annual lease payment received is $50,000. And the interest income is equal to our previous receivable times that 12% to give us $18,224. And so then the reduction of the lease receivable would be the difference, so $50,000 minus our $18,000, and so that gives us a reduction of $31,000, and so we can just say that previous balance minus this current reduction gives us a new balance. And so then we can keep doing the same thing, and really we should actually be able to pull the rest of this row down. And let's make sure once we put our 50,000 in here, that it works out. And so we were able to just pull down those formulas of saying the previous balance times 12%, and then this formula saying the payment minus the interest, and then this formula being the previous lease receivable minus the reduction, and we pulled that the whole way down. And then once we plugged all of our payments in, it works out in our table, and we have a 0 balance at the end. So that is always a good sign. Then finally, prepare the journal entries for Bernie, the leaser, for the years 2019 and 2020. So January 1, 2019, we'll start out with the lease receivable and a credit to sales revenue. And this is going to be for the 151,867. Then also on the first, we need to debit cost of goods sold and credit equipment leased to others. And so this is that reclassification of that asset being equipment leased to others as opposed to equipment being used by our own company. And this is for the $130,000. Then on December 31st, we will have our lease receivable and interest income for the $18,000 from our table. I guess I should have indented these. And also on the 31st, we'll show the payment receipt of $50,000. So a debit to cash and a credit to lease receivable. For the $50,000. Okay, then we can move on to the year 2020. And in this year, we don't have to do this January 1st entry. We're really just dealing with December 31st. So I'll copy these down. I'm going to put here December 31st, 2020. Okay, I'm just going to type it here. We have lease receivable of $14,410. And then the same cash payment for the $50,000, or cash payment from the other party for the $50,000, decreasing our lease receivable by that $50,000. And that concludes this one.